Hello, folks. It is Saturday, October 28th. It's about 8:30 in the evening on the East Coast of the United States. I was looking at some bank stocks today, and I want to share with you what I found, what I saw. So let me share my screen here and we'll get started. So bank sector stocks. This was the news that caused me to go look at the bank stocks today. So this is Jamie Dimon. For the first time in 18 years that he's been CEO at JP Morgan Bank, he's going to sell some of his shares. And so I thought that was interesting. And whenever an insider like that, Jamie Dimon certainly an insider when it comes to the banking sector. To see him selling shares, kind of wonder, okay, what does he know that I don't know? And so anyway, let's look at the highlights of this article. So first time, almost 18 years, he's selling shares. This is the cover story, and it may be the truth that he's selling for financial diversification and tax planning purposes. Okay. And he and his family, they're selling 1 million of their 8.6 million shares. And so, he's still holding a very significant position in the bank. This is one of the things that he has said this month in interviews. This may be the most dangerous time the world has seen in decades. And I forget this particular interview, whether they were talking financial markets or geopolitics, but obviously elevated risk in both of those areas. We've got interest rates at a high level, and they've been raised very quickly. And so anyway, we've got a number of industries, sectors of the economy that are struggling with higher interest rates. And then, of course, geopolitics. We've got two areas of significant conflict in the world at this point. So this is an article from October 19th. So we're going back 9 days. This is the Fed Chairman Powell talking about how the strong economy may still require rate increases. Now, the general expectation at this point is that we'll get another pause at this upcoming FOMC meeting, that we're not going to see interest rates raised again at this particular meeting. But then this is the chairman saying that, we may still have to raise rates some more. And of course, that's my bias. My expectation is for higher rates to come for a long time, potentially years. So, and inflation is another possible reason that the Fed might use as cover for raising rates. So, one thing, they can point at the strong economy, which I don't know how they're claiming that we have a strong economy. We're close to recession. But anyways, claiming that there is a strong economy gives them a cover story for raising rates. And then, of course, inflation, the idea that they're fighting inflation, which, of course, they aren't, also gives them cover to continue raising rates if they choose to. This particular article is saying, high inflation will dog the world economy next year. That certainly aligns with my expectations. I've talked in the last few videos about inflation in food in particular. So, and then this is suggesting that interest rates will also remain higher for longer. Expectation that central banks will start cutting interest rates by the middle of 2024. But then also pointing out that some economists are thinking that will get pushed back even further, and that it will be late in 2024 before central banks start cutting rates. And of course, I don't expect them to cut rates at all. That's not my expectations. I'm expecting higher for longer years. As far, if you want to you want a measurement on how long is long, it's years. Economists and financial market traders reluctant to accept that view, and I understand that. I mean, there are people that are still expecting a pivot, and I don't think that that's what's going to occur. But I fully acknowledge that there are people who still think that the central banks will pivot and start heading lower. In my opinion, they can't. They have to do everything they can to attract legitimate organic buyers for their debt instruments. And that means higher rates, not lower rates. There are two things that are competing with stocks at this point. We've got higher interest rates. And remember, in this video, we're going to talk about bank stocks and the health of those bank stocks and the banking sector in general. Two things going on in the economy right now. We've got higher interest rates. And so why would me or anyone else leave money in the bank when we can go buy a 1-year treasury bill, which supposedly has zero risk, which of course, if you believe that, I got a bridge to sell you. But anyway, the generally accepted idea about U.S. treasuries is that they are zero risk. So anyway, if I can go invest at 5.4% with zero risk, why would I let my money sit in a bank drawing essentially zero interest? So that's one competitor for banks right now. And then the other is, well, this is still in the banking sector, but money market funds are offering 4.5%. If you've got $25,000 or more that you're willing to let sit in a bank, you can get 4.5%. And so anyway, people are pulling their cash out of the banks and moving to alternatives. They're moving into U.S. Treasury debt. They're moving into money market funds. They're moving into precious metals. Recently, they've been moving into Bitcoin. Bitcoin's been moving pretty significantly. So, but anyway, point of this video, I want to look at the banking sector, and in particular, the regional banks. Because remember back in May, when we had the 3 bank failures, they were regional banks, not the big banks. And so we're going to be looking at regional banks in this video, weekly time frame, and I cherry picked. Let me say up front, I cherry picked and specifically looked for the ugliest charts that I could find in the regional banking sector. There are 4,800 banks in the United States. And so there are a lot of banks. I'm not going to look at that many stocks. So I did do some filtering to find the ugliest, the ones that are worst performers. But that makes sense, because if we're going to get another round of bank failures, and that's a potential reason why Jamie Dimon might be selling some of his bank shares, is because he knows or expects another round of bank failures. That would most likely occur in the weakest banks. And so it makes sense for me to filter on the weakest banks based on their stock performance. So anyway, this is IAT. This is an ETF, actually. So this is an ETF of regional bank stocks. I think they have 39 individual banks that are represented in this ETF. And of course, we can see we've got this horizontal support resistance zone and got a big plunge. This is back in March. Big plunge below that support level or potential support level, and then tested it from below, and price started dropping from that level. currently sitting on what could be support potentially from this prior low, but notice that we've got rising volume. So declining price on rising volume, that's always a bearish indicator. And of course, 10-week moving average below the 40-week moving average. So bearish there. We can see in the accumulation distribution indicator that investors, they've been divesting themselves of this stock or this ETF since all the way back to mid 21, and of course a big decrease again in the earlier part of this year, and then mostly flat in the latter part of the year. MACD in bear mode, suggesting that the primary trend is downwards. Energy is very low. So this ETF does not look good. And again, it represents 39 individual regional banks in this particular ETF. So, and then there's the weighting within the ETF. Let's see, Home Street Bank, just steady decline since peak in early 2022, and recently dropped below. This was the IPO or initial stock issuance price. Notice how price dropped below that level, tested it from below, and then started heading lower. Again, rising volume. This particular stock price in the past, we're in the weekly time frame, so price in the last 2 weeks has actually dropped below what could have been a support level. So bearish action there in price. MACD in bear mode, energy very low. So not a pretty stock there. Summit State Bank, big decline this is the week that just closed. So they lost 11.3% just last week. Obviously, investors have been divesting themselves of this stock for the past, 2 years plus, actually. MACD dropping down into bear mode, energy very low. So again, very ugly stock here. Price has dropped below and closed below this potential support level. Let's keep rolling. First Foundation, again, another, whether this was IPO, first issuance, price has dropped below that level quite decisively, again, back in March of this year, and tested that level from below and then rolled over. Big green volume bar Friday, which is bullish, but look at that candle. That's a very bearish looking candlestick. You could almost call that a graveyard doji with that big long upper wick and almost no lower wick. Gravestone doji in Japanese candle terms. MACD in bear mode. Again, investors divesting themselves of this stock. Energy very low. So again, another very bearish looking chart. Territorial Bancorp, again, last couple of weeks dropped below what could have been a support. What could have been a support level, and just steadily dropping lower. We can see in the accumulation distribution, investors are continuing to bail out of this bank. That's just a really ugly chart. Energy very low, MACD in bear mode. So not a good looking chart. But again, I want to make clear, I cherry picked. I intentionally looked for the ugliest regional bank stocks I could find. And so that's what we're looking at. Again, another bank that has decisively dropped below a support level, didn't quite test it from below. that's a sign of weakness. The fact that price tried to rise back up and test that level from below and couldn't even get that far before new selling. So we can see the, selling with that big bar of volume, and then price, dropped from there, mostly sideways since then for the last, that's probably 3 months, mostly sideways action, 77% loss between what is that, early this year and this week, 77% loss. So, ouch. If you happen to be holding this bank in your portfolio, that's an ugly loss. Not pretty based on accumulation distribution. Obviously, investors not only divesting themselves, but basically puking these shares out into the market. MACD in bear mode, energy very low. So not a pretty chart at all. NatWest Group, again, weekly time frame. This is just the past week. The stock lost almost 13%, 12.99%. Big slice through a support level. It acted as support here. We can see it acted as resistance, support, and then didn't even get a bounce, just sliced right through that level like it wasn't even there. Closed nearly at the low of that price bar. There's a tiny wick there, but not much. So very bearish candle. That's an impulsive candle, indication of elevated energy and, of course, rising volume. So very bearish price action, MACD in bear mode, energy very low, investors bailing on this stock. So now we're into the rest of these charts are bond ETFs. We've looked at these charts recently. I just would take a quick run through them. We want to remember that this is the kind of stuff that banks are holding in their portfolio. They invest in bonds. And so here we've got U.S. bonds, no tips or municipal bonds, 24% loss, rising volume on declining price, bearish action in this ETF. And so if we're trying to gain insight into what's happening at the banks, this is what's happening at the banks because, again, they're invested in bonds. 53% loss, rising volume on declining price, just very bearish action across the whole bond duration curve. This was 20 plus years. I think the average duration is 26 years in this particular ETF. 10 to 20 years, 45% loss. This is agency debt, so real estate-backed debt, Fannie Mae, Ginnie Mae, Freddie Mac. 24% loss just going back to early 2020. So 24% loss from this point. Again, ugly action. Effective duration 6 years. U.S. Treasuries down 24%, dropped through what might have been a support level. This chart, this is a new chart. I don't think we've looked at it recently. Oh, this is what I was thinking. Effective duration 26 years. So this is PIMCO's ETF, U.S. Treasury bonds, 25 years plus. Effective duration across the portfolio is 26 years. And again, just very ugly action. Investors divesting themselves, MACD in bear mode, energy very low, declining price on rising volume. Look at that volume. Just just ugly all around. Not a pretty chart at all. And so anyway, wanted to look at the banking sector after seeing this article. Wanted to get an idea of what the banking sector looked like today, and in particular the regional banks, because that's where we had trouble last time. And so that's all I've got in this video. Talk to you soon.